There have been 54 clearly identifiable bubbles since the coin crisis of 1622, with the average bubble lasting 7.5 years. Since e-commerce is up 8 times over the past 9 years, the question is, does it share the characteristics of a bubble? Now, bubbles in all asset classes share similar characteristics. Asset prices rises significantly, rapidly and continuously. A fear of missing out causes herding behavior in markets, causing instability. Many participants actually recognize that they are in a bubble, yet they ignore the fundamentals. And investor risk tolerance increases because this time things are different. Now today there are many parallels between US e-commerce and tech in the late 90s, namely dozens of new entrants, share prices dramatically outperforming, and massive price tags for loss-making businesses. Let's have a closer look at the facts. While the rate of new companies set to list this year is set to exceed the high of 1999, this is not disrupting equity markets, as the overall supply of equity have actually decreased over the past 5 years due to share repurchases. Valuation metrics are high, but nothing like what we saw in 2000, and most importantly, e-commerce firms listing today actually represent real businesses. E-commerce businesses today are 12 years old on average, with robust business models that have led to greater scale, competitive advantages, and profitable growth. So while relative valuation seems high, the market is rightfully paying up for capital-efficient business models that have changed the way consumers behave and transact. As an example, Facebook and Google both have customers going into the billions, creating powerful network effects. As Facebook increases its database of memories, existing users are more reluctant to leave, while new users are more enticed to join. As more content is added to the internet, Google's search capabilities become more needed. Thus, as these platforms grow, the value of the platform grows, thereby justifying the valuation. Also, with such large captive customer bases, it creates enormous optionality to deliver new value-accretive services in the future. However, caution is warranted investing in companies that are simply repackaging traditional old business models in an internet guise, like Uber as an example. Uber talks about revolutionizing personal transport, but it is just an improved version of the traditional taxi, with low switching costs, similar economics, and it's difficult to justify the high valuation. In our view, there is enough evidence to suggest that current e-commerce trends does indicate a degree of froth, but nothing like what transpired in the dot-com bubble. And although there is limited systematic risk to global equity markets, investors in some of these new internet companies will be sorely disappointed, as many of the sub-industries lack sufficient scale and network effects.